All I was programmed to think about was I want as high an equity allocation as possible so that I can maximize returns. Most people don't realize that the majority of your wealth building capacity is driven by your savings rate. Somewhere upwards of 70% of that, your success is determined by that savings rate. Two lifelong friends document and share their personal stories as they seek financial independence and to retire early. One reaches FIRE in 2020 during a global pandemic, inspiring the other to play catch up. This is Two Sides of FI. All right, Jay, we're continuing on with our theme of really deconstructing our portfolios and just kind of laying it all out there.
Can't get enough.
We've had so many discussions about asset allocation that I started looking at my own portfolio with a different set of eyes. And I thought, am I really doing the right thing here? And so all of these discussions led me to really make kind of a major decision with our portfolio. And I say major just because I had nothing but equities in the portfolio before, and now I don't. And I just made that decision recently. So kind of wanted to use this as a chance to talk through the whole decision-making process around reallocating the portfolio and why we did it, everything associated with it, because I'm going to be honest, it was not easy.
Right.
And I'm still not convinced I did the right thing.
Anyone who's watched previous episodes knows that we have talked about your approach, which I guess in my head was definitely thinking of it's like a to the moon type strategy. And you sure have capitalized on the last 12 years of this bull run. And that's awesome that you have. But of course, as you started approaching your target date, which is right at the bottom of the screen at the start of all these episodes, it's natural to start thinking about the other aspects of your portfolio. And I'm not at all surprised that asset allocation was the thing, just talking about that repeatedly was the thing that drove you to that. I am happy that it did. Not saying you need to be have the same risk tolerance as I do, but certainly I care a lot about your portfolio success. So I am definitely looking forward to this conversation.
That is basically the place that we need to start, I think, is talking about risk. And there are many different risks associated with the FIRE path, and also determining an asset allocation. And I guess I had always seen myself as a very risk tolerant person. I am perfectly comfortable watching a portfolio go down by 50%. And, I don't like that. But for all the time I've been investing, when that's happened, I've just ignored and kept on buying. And it's easy, from your side of FI, I bet it looks much different than my side of FI.
Yeah, it sure does, right? When you're accumulating, you're looking at market drops as buying opportunities.
Right.
Not saying you should do crazy things when the market drops and sell off all your assets to put more in the market, but hey, buying that dollar cost averaging that you do, whatever your regular investment strategy is, you get to take advantage of those downturns. But you are right to wonder what it's like on the other side of FI, because by the way, when we had the first very sharp COVID downturn, it gave me pause, shall we say.
And you were on the verge of entering RE there, right?
Correct. Yeah.
You had
I had achieved FI, but I had not yet pulled the trigger on leaving my place of work, but I was very close to it. The end was in sight. I'm fond of saying, if you have a good, and I've totally stolen this quote from somebody else, by the way, if you have a good plan before something bad happens, you still have a good plan after it happens. But I'm still human and, not a machine. So yes, I start thinking about the plan as soon as that downturn happened and wondered, well, am I well protected enough? Let me redo that calculation about how much cash I'm going to have and what's my fixed income look like? Yeah, for sure that happened.
So if I project myself forward to a position like that, and part of this really refocusing on the asset allocation is a result of seeing how close I am to reaching that number and just doing all the calculations. If I put myself in that position, if I were right on the cusp of reaching my FI number and I had a major downtick and my portfolio was 100% stocks like it used to be, that has a different set of risks. And that's, delaying retirement essentially.
That's right.
And we don't talk about that very often, right? This idea about that's a real risk too.
Yeah, you're right. I mean, just, you and I have, partaken in the fire community online for a number of years now, and we know how much sequence of return risk comes up, right? That
Right.
what could happen to your portfolio in a downturn after you start withdrawing from your portfolio, right? That rightfully gets a lot of traffic. But what doesn't is what you just said, and that's that retirement date risk. I have a date in mind that I want to be done with this thing. I want to pull the trigger on retiring from my, primary career. And oh, by the way, the market drops substantially and I'm not prepared to absorb that. And now my date has to change.
Right.
Now, it sounded to me like that was kind of a non-negotiable thing for you. Is that right? Are you pretty set on your own trajectory?
I mean, the closer that I get to this number, the more it feels like a fixed point. It doesn't have to be, no. And so as part of this reevaluating my asset allocation, I went to a pretty well-known site online and basically posted all the details of my information anonymously, of course. But it was a pretty thorough airing of everything that I have. And I did this because I wanted some feedback on a couple of things, and actually got feedback on a lot more things than I was anticipating. But I did this just trying to get down some of the mechanics of, okay, if I wanted to change this allocation or I wanted to do this or that, what should I do here?
Right.
And I was, in a way, and this isn't to discount all the discussions you and I have had, but in a way I was looking to outsource some of the decision making and kind of get some contrarian opinions. And the site I went to was a pretty conservative site. So I expected that the information that I was posting and the general theme of fire, it's not always looked on kindly.
No.
And that's actually perfect. That's actually what I wanted, because I feel like I have a pretty extreme view of that situation. And this forum obviously has a different view. And a lot of the feedback that I got was, hey, what you're posting here with this hard and fast date of 2024, that's a pretty inflexible position. And in general, inflexible positions tend to yield very difficult situations to manage. And so it's, I'll say the date feels fixed to me, but part of this reevaluation process has made me think differently about that. Maybe treat it a little differently, or maybe there's some in between. Like maybe I can really dial the risk way back on the portfolio and keep that hard and fast state.
Yeah, I really like that you posted there, because it's very easy to get kind of stuck in this groupthink. And as much as you and I like a variety of subreddits that we've discussed on this show, there's some groupthink. And even just today, I was looking at, what's the latest guidance and thoughts on, bonds and their role in a retirement portfolio for someone in the fire community. And,
you were looking on Reddit?
Yeah, of course.
Oh,
right.
geez.
And so you find the opposite perspective, right? There's a small minority of people who are like, yeah, bond tents are a good idea. And, here's how you do it. Other people are like, nope, bonds are worthless. Stay in 100%. It's going to correct. Don't really worry about it. Just, blinders are on. And somewhere in between the extremes of those different communities, plus your own sort of, personality and your specific assets is where like perfection will lie. So I like that you're gathering information from multiple camps, and I'm really curious to hear what kind of feedback you got.
Well, I mean, it's so true. Like the confirmation bias, like if you want to find confirmation of your plan, you can find it, in the extreme on the internet, whether that's Bogleheads or it's Reddit. As we build into toward FI, right? We're working toward FI. We're on the path. We have a plan. The plan for most of your FI journey is pretty easy, right?
Yeah.
High savings rate. You want to invest in some low cost index funds. I mean, that's the kind of template, right? And just stick to your plan. I'm basically 3 years out, a little bit less than 3 years out. And so that really is a pretty big transition point where you start needing a different plan. So what I did was I created this post. I basically said, here's what I'm bringing in. Here's what I'm saving every year. These are my accounts. These are the funds I have access to. My asset allocation currently, like when I made the post, was 100% equities. And I said, I know that's not a smart strategy because I'm basically 3 years out from FI. So I want to adjust it to a more reasonable asset allocation of 85-15, which I mean, we can
15
talk
bonds, 85 stock.
equities. That's right. Yeah. And then I just was asking for some information on the mechanics of actually rebalancing, so I was looking for kind of some subtle details on it. And then also, like, based on the funds that I have access to, bond funds in particular, fixed income assets, because they're in, pre-tax accounts and things like that. What do you think? Because it's not like I have, I can just go and choose whatever I want in all of my retirement accounts. It has to be based on what the employer is providing for my wife and these various other things that we have. And then I had some other questions about Roth conversions and things like that. So, like, those are tangential to this conversation, because really the feedback that I started getting was, well, based on what, I mean, the number one piece of feedback was like, whoa, way too risky.
So it's not just me, is what you're saying.
Right, exactly. Basically, you're insane for having an asset allocation that high. It's way too risky. And the thing that I failed to realize here was the risk that I was taking was not worth the reward that I was seeking to get. All I was programmed to think about was, I want as high an equity, allocation as possible so that I can maximize returns. Returns.
Sounds good.
Right? And someone pointed out to me that obviously the amount of money that I was saving between now and then, my annual contributions, was going to get me to my FI number with or without any returns in the stock market. And it's so silly that I couldn't see that. But the person who pointed this out basically said, most people don't realize that the majority of your wealth building capacity is driven by your savings rate. And I think that the percentage they used was somewhere upwards of 70% of that. Your success is determined by that savings rate. And of course, it's like, if I look at those numbers, I'm like, well, geez, I don't have to do it. Yeah. I mean, all I need to do is maintain that savings rate based on that income level, and I've got it. So I should be 100% bonds, like 100% safe. And in fact, some people suggested some pretty ridiculous things about how they thought I should allocate, and pretty low percentages of stocks, which doesn't really work for a FIRE portfolio, I think.
Right, exactly. Yeah, and did you disclose your age as well? Because to me, that's obvious, right? You don't want to outlive your money.
That's
so you're
right.
going to need that engine from the stock to keep things going.
Totally. Yeah. So, and I mean, I guess people can fill in the blanks as to how long that portfolio needs to last, but it's at least 40 years. And like you're planning on a 50-year retirement. I don't think
worst case, I won't die.
Yeah. But, and then I talked about my proposed withdrawal rate being 3.5% based on, the portfolio. And, of course I got feedback on that, way too low. I got a bunch of feedback that said you should keep working based on what you're earning every year. You need 10 years of expenses plus 3 years of cash. That was one of the comments that I got back. And, I don't expect to take all the advice, obviously, but it made me really rethink the decision to go 100% equities. And one of the comments that came back just basically referred me to Vanguard's sort of historical performance of different portfolio allocations. Have you seen this?
Yeah, I have. And
it's really telling. So 100% equity portfolio returns something like 10.3% versus an 80-20 portfolio, which returns 9.8%. And a 70-30 portfolio returns 9.4%. And if you look at total return on those different portfolios versus the risk that you're taking, I mean, it's much easier to live with a portfolio that's like 70-30 than it is to live with one that's 100% equities. And there's a reason why you, consulting with financial advisors, have a diversified portfolio, right?
Yep.
What is it?
Absolutely. and that, to me, risk mitigation is an important part of the puzzle. Yeah. And yes, that risk tolerance versus risk capacity, it's always there. But I'm not the most conservative person on the planet, but I also want to make sure that I'm diverse enough to capture the mix of upside, potential benefit, and mitigate downside risk. So, I mean, that's why it is that way. And
There's also a shortfall risk if you go too far in the other direction. So if you change your allocation to be too heavy on the bond side, you may not have that sustaining engine that's going to drive the portfolio into a long retirement, which is a special concern for people in the FIRE community. So I'm kind of weighing that in this whole decision process. Like, well, I don't want to go too low. Like 85% felt low to me, but then everyone's like, no, 60-40. Like you should just go 60-40. So I'm thinking about that. And then at a certain point, I think I said this to you, I was like, I might as well just go all cash, man. Just
you did say
like,
that to me.
why do I even want to be in bonds? Because part of this process is thinking about, okay, if I'm going to diversify the portfolio beyond stocks, what am I going to choose? I mean, I'm not going to go out and buy individual bonds. I feel wholly unqualified to make a decision about shopping around on the bond market. It just feels so crazy. But just to go to cash, that raises the other risk in this whole equation, which is inflation risk. Right?
Yeah, absolutely. Unless you have a mountain-sized pile of cash
I don't.
that you're willing to watch lose value with inflation, and cash not the answer either. Yeah. So, I mean, I suspect your journey took you looking at all different instruments, and I bonds are very popular now, and some of these other things. What did that look like?
Yeah. So, well, I want to get to that, but I also do want to kind of back into this overarching theme. The thing that matters most here is the savings rate, and like maximizing the savings rate that's the first level of decision making. So before you even choose the asset allocation, you have to determine what that is. That's the thing it's going to have the biggest impact on your ability to grow your wealth over time. So I started looking at this, and this is just after tax net this year. It's been about 73%. And we saved a little more than that for kids' college and everything. And I feel like that's right there. I don't know how we
super high
can save more than that. Do you remember what you were saving in your sort of mid to late term of reaching FI?
It was not 73%.
Yeah.
It was certainly lower than that. Yeah. I mean, it was a mix over time. But, as my sort of compensation went to a certain level, I was able to save more and put any sort of unusual compensation like bonus compensation 100% into my portfolio. So it varied quite a bit.
Yeah. There's a great post on Go Curry Cracker about this, and it shows just the change in savings rate and what that does to your FI timeline. It's really actually fascinating graph. And he also compares that to just changing your allocations between 100% stock portfolio. I mean, he's for a while, I think he's 7 years into retirement, something like 8 years into retirement.
Yeah, sounds about right.
But super heavy on the stock train for a very long time, and has since kind of dialed back to a less aggressive allocation. But I'll link that post up too in the notes. Part of this transition zone that I'm in, you started helping me thinking about drawdown strategy and asset location. And you can't just think about your asset allocation, your asset classes, if you want to call it that, without also thinking about where you're going to put them.
Right. Because, for example, you are talking about retiring at around 50, which means that you have 9.5 years to cover in some fashion before you can sensibly access your retirement type accounts, your 401ks, 403bs, et cetera, right?
It's that. And it's also, if you, like me, you have a heavy stock position, right? 100% stocks. You have a taxable brokerage and you have a, tax deferred a series of accounts, which are generally the retirement accounts, right? It's easy to move money in the tax deferred accounts without incurring any tax ramifications.
That's right.
But anytime you're in a taxable account, you want to change allocation and you're all stocks, it's very difficult to unwind a mistake that you are potentially making like years prior. It is not just about reallocating and rebalancing here. It's also about thinking, what is the larger plan that I'm operating under? And that larger plan has to encompass not just the next 3 years, as I transition into FI, hopefully, but it's got to be the next 10 years, the next 15 years. Like to your point, 59 and a half. Okay. I don't have access to a large chunk of these funds until that point. Currently the location of our funds right now is about 30% in taxable and 70% of it is in tax deferred.
Got it.
And so I don't have any HSA accounts. I don't have any Roth accounts. I was not fortunate enough to build those assets. I expect to start building those when I enter retirement, but just the general breakdown is 30-70 between taxable and tax deferred. So adding to the complexity of the decision is figuring out, okay, it's not enough just to buy bonds, right? It's like, it's also where, trade some stocks for bonds, but it's also where to put them.
Right. So if I can, I think what you're talking about, and please correct me if I'm wrong, is you're saying that when you talk about mistakes that can be made and unwinding decisions, that things like embedded gains in the stocks in your brokerage account, to exchange those will have tax ramifications.
Absolutely. Yeah. And it's I mean, if you are someone who is earning a high income, you're getting close to FI, those decisions, if you're trying to unwind these positions while you're earning a high income, it's a very heavy tax hit, right?
Right.
So let's just say, for example, I want to take my 100% portfolio and turn it into an 80-20, but I wanted the 80-20 to be in both, that fractional representation to be in both my taxable account and my tax deferred account. Easy to do in the tax deferred. Just sell off my stocks, buy the bonds that I want, or buy whatever fixed income assets I want. Good to go. In the taxable, I have to take a tax hit. Taking the tax hit would just be a long-term capital gain.
That's right.
At whatever.
Which, depending on your income level,
that's right.
Could be 0. What is it? 0, 15, or 20%, right?
That's right. Yeah. How do you position assets in an accessible way, say during a downturn that, if your stocks are taking a hit, you don't want to be selling stocks when they're low, right? You want to have options for other things to sell. And that was kind of the moment of crystallization for me. Like, okay, in a drawdown, I really do need these. It doesn't matter that I may be risk, tolerant enough to see the portfolio cut in half, but it's a reality that if I run out of cash, let's say I'm building an 18-month cash buffer,
right?
A downturn could definitely last more than 18 months.
Right. You need something else to sell.
Right. Yeah. And it's got to be in a place that, I can easily access without huge tax ramifications. So I definitely, in taxable, I don't want to be selling stocks when they're way down. So
no,
is that
right? And for especially for anybody who's sort of newer to this, basically, if you sell stocks when stocks are high, right, versus when you sell them low, in the latter case, you have to sell more shares of a stock or more shares in a mutual fund for the same amount of dollars. And so that's why you wouldn't want to sell stocks ever when they're down if you can help it.
Optionality in this show, it's just been a recurring theme. So
yeah, absolutely.
It definitely made me realize, okay, I don't have enough options here.
I'm curious about how you're starting to develop a strategy here. And I was wondering what kinds of sources you considered, so for me, obviously I'm working with financial advisors, but in essence, one of the sort of closest representations of what I do is kind of a flavor on the 3-bucket strategy, right? And in the taxable bucket, I have a position in bonds, primarily municipal bonds that I'm able to access if I need to sell bonds, for example. But are there specific approaches you were looking at, and what did you consider versus what did you elect to go with? I'm curious about what that process looked like for you.
Yeah. So I looked at your portfolio, quite honestly. I mean, you've been great in sharing with me how you have things divided up, and, I use that as inspiration, but I also said that feels complex enough to me that I can't replicate that. I don't feel like I would be able to manage that long-term, which is, maybe I'll trend more toward complexity, but at this point I would basically look at, I looked at the kind of Boglehead 3-fund portfolio, and I just said, which is, for anyone who doesn't know, it's a, equity allocation that is divided between the total U.S. stock market and an international stock market, international stock market, and then a bond allocation, basically. So those are the three parts of the pie, and you sort of choose how to divide them up. I defaulted to a 70-30 allocation. So, and that means basically 70% of the entire phi number was going to be dedicated towards stocks. And then of that, I was going to, allocate a portion of that to international funds. So right now I'm targeting 10% of that number as being international. I don't know, may go a little higher, just based on how I'm feeling. And then 30% of that would be toward fixed income assets. And that includes cash. So there'd be, 25% bonds and probably 5% cash, which would, the 5% cash would be 18 months worth of expenses. That's kind of how I'm looking at it. But like you said, within that range of choice here. So I'm looking at index funds in general. Let's just, if I think about them as being ETFs, it would be VTI, which is the VTSAX equivalent. Okay. Total stock market fund. There's VXUS. So that's the international fund. And then a fund like BND, which would be a total bond market fund. And that's US bond market. It's not international. And I guess the equivalent to that would be VBTLX as a Vanguard fund.
And can I ask you a question about that?
Yeah.
Did you think about a potential role for REITs or other alternatives in that mix, or is that kind of a future thought? And right now your aim is simplicity. Like, help me understand how you thought about that.
I thought about the alternatives, and I like, it's enticing to me. I looked at some of the market neutral fund information you sent me, and it's interesting to me. And yet I also feel like I don't know enough about it to be an informed consumer. I don't know how I would use that. I mean, do you know, I mean, you have financial advisors who are sitting at, your wingmen there, but how would you use sort of alternative?
Sure. Well, I think some of those alternative funds are meant to sort of occupy a happy place between pure equities and pure bonds.
Yeah.
Some of them, like the one you mentioned, are more of a derivative type of instrument where they may even have two different strategies at work in that specific fund. And that's an actively managed fund. We're not talking about a passive indexed fund here. So that's a little different thing, and that will come at a higher expense ratio, which some people will be very averse to, and that's a personal decision, right? Like everything in this episode, there's not just one way to do these things. It is a way to hedge against multiple types of risk. So, for example, It might hedge against both interest rate risk and market volatility risk using multiple strategies. And so that specific fund you asked about, that market neutral fund, is more about having something that exists in your brokerage account that you could elect to sell if indeed it didn't make sense to sell either bonds or stocks, and something that is less correlated to each of those things.
Right. Your term for it was like risk off, right? You're trying to develop a portfolio where the risks are they're uncorrelated.
Right. Yeah. And it's also true that, people who are sort of paid to be financial advisors, which is neither of us, do think about the world in terms of a risk on and risk off perspective, and having a balance of that, which is based on an individual's risk tolerance and risk capacity.
Yeah. Okay. I mean, to answer your question about REITs, REITs are a part of VTI. They're 4%. And I know you have more REITs in your portfolio than I do, but here again, it's kind of good enough for me. Like if I had a strong,
no judgment here.
Yeah. If I had a strong reason or expertise, maybe, which would tell me to do more than 4%, I'd probably say yes. But that doesn't mean that your portfolio is, I'm sure your portfolio is going to perform better than mine in the long run. So total return is going to be higher. But some of this, it just felt so overwhelming at a certain point. And I wanted to kind of share the responsibility. So of course I was asking you, I put this out to the forums, trying to get multiple opinions there. I'm asking my wife, Laura.
Yeah, curious to hear about that and how those conversations went.